In August, the U.S. economy added 156,000 non-farm payrolls while the unemployment rate ticked up slightly to 4.4%. Expectations were for job gains to total 180,000 and the unemployment rate was expected to hold at 4.3%. Gold, meanwhile, continued its recent rally, closing the week at $1,329 an ounce, while the 10-year yield backed up just a touch to % after hitting % earlier in the week. In the coming week, markets will contend with U.S. lawmakers returning to Washington, D.C. after the August recess with tax reform and passing a budget bill to raise the debt ceiling at top of mind. On Friday, Bloomberg reported that the Trump administration was considering tying a debt ceiling bill to an initial relief package for Hurricane Harvey aid in an effort to quell concerns over a government shutdown. A later report suggested House Republicans may be against this plan. On the economic side of things, this week will be a slower one after we got a rush of month-end data on July and August ahead of the holiday, and the corporate calendar is also expected to be light. Notable earnings this coming week are expected to include Kroger, KR, and HP Enterprise, HPE. When a jobs report misses expectations, some might be inclined to call it a bad report. And while Friday's August jobs report missed what economists had forecast, with lackluster wage gains certainly remaining a point of weakness for the economy overall, the report still points to a labor market that remains solid, in line with other data we got this week. On Tuesday, data from the Conference Board indicated that at least among consumers, jobs are seen as plentiful by the highest percentage of folks since 2001. And on Wednesday, private payroll figures from data processing firm ADP showed that hiring remains robust in the economy with 237,000 jobs added in August. Following this report, Mark Zandi, chief economist of Moody's Analytics, said that in the U.S. economy, mounting labor shortages are set to get much worse. Inside Friday's jobs report, we also saw encouraging signs when it comes to labor force flows. As highlighted by Lucas Puente of consultancy Thumbtack, the share of unemployed workers who got jobs in August was the highest since October 2008. And over the last several months, unemployed workers have become more likely to get a job than leave the workforce, flipping a trend that persisted from 2009 through 2015. This kind of improvement beyond the headline readings on job gains and unemployment levels shows the strength of the labor market. It also shows why, despite the economic recovery being in its 8th year, there are no clear signs of a slowdown on the horizon. And as we highlighted on Thursday, strategists at Bespoke Investment Group noted that secondary indicators of labor market strength, for example, commentary from regional Fed surveys or consumer confidence data, were overwhelmingly positive in August. Additionally, there are statistical quirks in play that impacted Friday's numbers. Namely, seasonal adjustments. This year seems to be no different, and we suggest investors look to 3-month averages to smooth through any volatility and assess underlying trends. We noted Thursday that August payrolls have tended to underperform relative to expectations at as high a rate as any other month of the year. This trend played out again in 2017. Ian Shepherdson, an economist at Pantheon Macroeconomics, noted that August reports also tend to be revised up in subsequent reports, meaning this will be a theme to keep an eye on in September and October. And overall, Friday's report does not rewrite the narrative for the U.S. economy, the U.S. labor market, or the Federal Reserve as we head into the fall. Jim O'Sullivan, chief U.S. economist at High Frequency Economics, said Friday's report is more than strong enough for the Fed to begin the process of paring its balance sheet in September, adding that an additional rate hike in December is still on the table. Miles Udland is a writer at News Pulse Finance. Follow him on Twitter at Miles Udland.